Hi guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today we're talking all things your car loan and understanding some of the terms that get used either by dealerships or by the bank that you need to actually know. Now the reason why I'm doing this, it's on the back of starting a podcast series with the guys at cars.co.za where we will be simplifying your vehicle financing. So do look out for those videos coming up on their YouTube channel. Now remember that nothing that I say on this channel constitutes as financial advice. If you are looking for financial advice, please speak to somebody that is certified and registered with the FSCA to give you financial advice. So as I was saying, I'm doing this thing with cars.co.za, right? So last week they flew me down to Cape Town. Yes, when a content creator flew me down to Cape Town, a beautiful time in their studios, and we're talking about car financing. And one of the things that stood out there for me, because I was about to go into the process, is talking a little bit about how to trade in your car the best way possible. Now, the two things that stood out for me in that conversation is that there's a trade-in value and then what is called a settlement value. Now, the trade-in value, of course, is the value that the dealership is going to offer you, because remember, they're buying your car so that you can buy another car, so that they can sell you another car, basically. But remember that your car financing in most cases is sitting with an actual bank or a credit provider or a lender. So if you do have financing on a previous car or the car that you're trying to trade in, you need to settle that loan first. So those are the two terms that I was told about, and it was really exciting, really getting to learn about them. Now this week I decided, yes, baby girl is ready to buy her new car. Well, technically I'm buying a new car because my service plan is going to run out very soon, and I don't want to find myself sitting with a Range Rover that has no service plan, right? Because it's going to be very expensive. The parts are expensive and it just makes no absolute sense, right? So I decided I want to now trade in this car. So I went on cars.co.za and the other cars website, and I looked for a car, and I found the car of my dreams. So yesterday I went to Pretoria to go and actually view this thing, right? I get there, and the guy looks at my car, checks it out, takes a couple of pictures, asks me questions, and then he goes and does something somewhere, and then he comes back to me with a trade-in value, and he's like, this is how much we're willing to give you for your car, or we can get your car sold somewhere else. But essentially, this is how much we're willing to give you for your car, and then this is the money, whatever the trade-in value, you would use that as a deposit now for the next car. But you also first have to settle the other car. So what is your settlement on this car? And I'm like, I'm not really sure what my settlement is. I know what I still owe, but I know that if there's sometimes a penalty that is put on your settlement. So let me check on my West Bank statement, right? Download my statement quickly, and then boom, boom, boom. I'm now confronted with two amounts that I was like, what are these amounts? What's actually going on here? So the first amount is what's called the capital balance, and the second amount is called the actual contractual balance. And now I didn't know which one to give him, because I'm sitting there and I'm like, I actually don't know what these two words actually mean or what these two figures actually mean. And that is why I'm doing this video, to clarify some of those terms that do exist when it comes to car financing that many of us use very loosely, but sometimes we don't know what they actually mean. So I'm going to start with the basic ones that everybody knows. The first one I'm going to start off with interest rates, right? The interest rate basically is a percentage that you're going to pay on the actual capital that you are borrowing or that the bank is lending you. Remember, when you essentially are taking out a car loan, there's two amounts that you have to look at. The one is the capital amount. This is actually the price of the car. And the second one is actually the interest that is going to be charged on the overall loan over the contractual loan period that you're going to be taking it out on. And the one number that is really important in determining how much you pay every single month on that loan is the interest rate. So I always say, look at it as you renting out a property. The property represents the amount of money you're borrowing. For as long as you need the property, there's a rental that you need to pay, right? For as long as there's an outstanding balance, there's an amount of money, which is the installment that you're going to be paying. And these are generally come when it comes to installment lease credit agreements that one would take out, right? Now, with the interest rate, remember it is dependent on your personal credit score. So it is about your credit risk. When the lender looks at you, they've got to determine what your risk is and how much they are willing to borrow you at what percentage, right? Also important that sometimes you do find that in credit agreements, they may use the interest rate to make the deal affordable for some customers, where if they increase the interest rate that they are charging you, it does decrease the installment that you're going to pay every single month. So you've got to also be wary of that a higher installment does mean, a higher interest rate does mean that you're going to pay more in interest back to the lender, right? Now, speaking about interest rates, also very important to remember that there's two various interest rates that you can take up on a car loan. The one is called the fixed rate, and the other one is called your linked rate, sometimes also called the variable rate. Now, let's talk about the fixed rate, and I want to explain it this way. Remember when let's say for instance, you took out your car loan in January 2020, right? And they gave you 10% as the interest rate. Now, what happened is that in January, in February, in March, you would have paid a certain installment every over those months, right? Now, what happened is that we then got hit by COVID, and then there was a hard lockdown. Our economy became sluggish because there was not enough activity, and Lesetja Kganyago and the boys at the monetary policy tried to stimulate the economy by making borrowing a little bit cheaper in South Africa, and they lowered the repo rate, which is the rate at which they borrow commercial banks like Standard Bank, FNB, West Bank money, right? Now, when the repo rate gets lowered, it also means that the commercial banks need to lower the prime lending rate, which is the rate at which they borrow consumers like you and me, right? So it means that if you had a fixed rate while all of these things were happening in our market, it was becoming cheaper to borrow, your rate would have stayed fixed. It would not have budged, it would not have changed. So although those people that didn't have a fixed rate probably paid lesser in terms of their monthly installments, yours would have stayed the same. There obviously are benefits and or advantages and disadvantages of taking up a fixed rate, right? Because when the inverse also happens, if there's an increase in the repo rate, an increase in the prime lending rate, that means that there would be an increase if you did not have a fixed rate, right? So let's talk about the linked rate, which is then the alternative of a fixed rate. It's, as it is said, it is linked to the market and market economy. So again, using the same example, 2020, January, February, March, you would have paid a specific installment. But then when Lesetja Kganyago and the boys reduced the repo rate, which in turn reduces the prime lending rate, it would reduce your rate if you have a linked rate. It means that essentially from April, May, June, you probably did pay a lesser installment. If you don't know, go and check on your actual statement. You may see if there is a change if you do have what is called a linked rate. Some people call it the variable rate. So it's linked to what happens in the economy. Again, if you saw in the beginning of this year, Lesetja Kganyago and the monetary policy committee then increased the interest rates up, right? Or the Reserve Bank rather increased the interest rates. So this year, those of us who have a linked rate would have seen that the calculation now of our monthly installment would have actually gone up. So it's very important for you to choose the right type of interest rate for you, for your needs, for your budget. The next thing that I want to speak about is the deposit. The deposit basically is an upfront payment. You don't even need to even think about the deposit when you are structuring your credit deal. What you do need to do is to subtract that deposit amount that you want to pay from the actual total that you want to borrow from the bank. In actual fact, having a deposit means that you are going to be paying less in terms of interest. Why? Because you are borrowing less. I know a lot of people get confused because when you go onto affordability calculators, especially from the sites that sell cars or the banks that have vehicle asset finance loans, they will have deposit as one of the line items there that you would then put in. But it's important to remember that the deposit essentially is the money that you are paying upfront before you even borrow. So it actually means that you're going to be borrowing less. I want you to think about it this way. You're buying a car at 300,000 Rand, you're paying a 10% deposit, which means that it's 30,000 Rand. If you take 30,000 Rand away from 300,000, you're left with 270. So in essence, you're only financing 270,000 Rand. Now take the same maths, take the 10% that you would have been charged as an interest rate against 300,000 Rand, you will get a higher installment versus if you take it against 10% against 270,000 Rand, you're going to get a much lower installment. That just shows you that essentially, if you borrow less, you will pay less in interest. So that is why a deposit is a good idea. The third term that I want to speak about is the balloon payment. Now, the balloon payment is the reverse of what a deposit is. So let's say again, you buy a car at 300,000 Rand and then they say to you, there's going to be a balloon payment of 10%. By the way, 10% is very modest. These balloon payments can go up to 70, 80, 90%. So at 10%, it means that there's a 30,000 Rand that is now reserved from your deal. You still borrowed 300,000 Rand. So let's not run away from that. You still borrowed 300,000 Rand. However, they are freezing the 10%, which is the 30,000, and they calculate your installment based on the 270,000 Rand, assuming that when the loan period comes to an end, you will have a lump sum of 30,000 Rand so that the car's title deed can then be transferred to your name. The fourth one that I want to speak about are these two, the capital balance and the actual contract balance, which is what had Nicolette a little bit dizzy at some point. So the capital balance is basically the amount of money that you would owe at a specific moment minus any future interest that would be charged on the outstanding balance. So if you wanted to settle your car today, you would pay what is called the capital balance. However, very important for you to understand that on big loans, you need to give what is called a 3 months notice, 90-day notice to the lender that you are going to take yourself out of the agreement. But if you don't give that 3 months notice, they are going to charge you a penalty, and that penalty usually is up to the amount of interest they would have charged you on those 3 months or in those 3 months. That is the penalty that you're going to pay. So if your loan is above 250,000 Rand, the initial amount that you borrowed, that is considered a big loan, and it does then require you to give a 90-day notice or pay the penalty, which is the 3 months interest that you would have been charged over and above the capital balance. Then the actual contract balance is the amount that has been calculated over the maturity of the actual loan. So if you do take the loan to the last day of the actual loan, if it's 5 years and you take it to the last month of 5 years, that's the amount you are essentially going to pay. If you look at it, mine right now, there's an actual 100,000 Rand difference between my capital balance versus my actual contract balance. These are some of the terms that I wanted to speak about today, and I'm hoping that I would have helped you in some way. So, as I said, do look out for that podcast series with the guys at cars.co.za, also known as cars.coza. It will really assist you in finding the most efficient way of buying your car.